opportunities to work and present some unique concepts to your clients. I want to thank you all for joining, and also thank Ray and Jay Kellett for this presentation and for putting this together. Jay and I met, probably 6 months ago, and he had introduced this concept to me, and I was very excited to hear what they were working on and the strategy that they were implementing with clients in their portfolios. And I couldn't wait to be able to announce it, and the day is here, so let's get started. As I travel around and visit with each of you in your branches, what comes up constantly are comments around clients who are worried about inflation, right? Specifically around fixed income and obviously medium to longer maturity bond funds. We see it in the media. You know, it's a constant headline these days, concerns about inflation, and so there's a lot of this concept of protecting against inflation. This strategy that KCM has developed that's going to utilize some multinational, high-quality, dividend-paying stocks along with some inflationary protection strategies with hard assets and emerging markets and so forth, and they'll get into the details in just a minute. I think it's going to really resonate with your clients and hopefully with you today. So I'm really excited about getting through this presentation. So as you sit there, all I ask of you right now is, as you sit there, think about clients you've had these conversations with who have raised these concerns. Put yourself in their shoes and think, and as you listen to the presentation, think about what questions they might ask so that you can get that out there and you can become more comfortable with this concept. And finally, again, this is a specific strategy that KCM is implementing within some of their client portfolios or as a single strategy. So you can use it as you see fit with your clients, obviously working with KCM to ensure that you're able to effectively implement this strategy either as a single strategy or as part of a larger strategy. So with that said, I am going to turn it back over to Ray and Jay Kellett. And once again, I appreciate both Ray and Jay for putting this presentation together, and more specifically for creating this unique strategy. Jay, I've known Jay for many years, and he's a brilliant strategist, and I've always had a great deal of respect for he and his firm, and I think that this is just another example of a great opportunity with our partnership between Schwab Retail and KCM. So Ray, you want to take it over?
Thank you, Eric. Thank you for such a kind introduction. Well, as Eric said, our speaker today is Jay Kellett, who is KCM's CEO and founder. And just to give you a brief roadmap of where we're going with the presentation, there'll be 3 parts to the presentation. First, Jay will introduce KCM's 2010 equity portfolio strategy. And this is an equity strategy that's designed to provide clients with dividends and dividend growth, as well as protection against inflation and protection against a falling dollar. In the second part of our presentation, Jay will provide you with an update of KCM's fixed income strategy. We will discuss what types of bonds we think clients should be buying, as well as where should they be on the yield curve. And the third part of our presentation will be a question and answer period where we encourage you to ask any question on any subject that you like. And before we get started, you should see a small control panel on your screen. The top part of the control panel is an arrow that you use to minimize or maximize the size of the control panel. There's a little middle box which has a rectangle that minimizes or maximizes your screen. And in the bottom of the control panel is an icon of a little hand, which you use to raise your hand when you want to ask a question. So let's see if this is working. Can everybody please click on the icon of the little hand? Okay, great. Fantastic. Thank you very much. We're ready to begin. Jay.
Thank you, and thank you, Ray, and thank you very much, Eric. It's a pleasure to be allowed to make this presentation. What we're going to try to do today is take a look at KCM's overall view of the markets, both domestically and around the world, where we are in the business cycle, look where the opportunities are, look where what our market themes are, build a portfolio, and show you how in building that portfolio we're going to position ourselves, or we think you should be positioned for 2010 and going into 2011. Our market themes for 2010. First of all, we believe that there's a broad-based global economic recovery. We think it'll continue throughout 2010 and into 2011 and maybe further on into 2012. We believe that the stock markets going forward will be positive, but that most of the appreciation, especially for the U.S. market in this cycle, is behind us, and I'll show you why in some upcoming charts. We believe that emerging markets will be growing faster than the U.S. That's pretty much consensus thinking, and we agree with it. We think that short-term interest rates will remain low. The Fed has said they're going to keep them low, and the short end of the curve is controlled by the Federal Reserve. But as the economy gets stronger and as the Fed becomes comfortable that the economy is self-sustaining, they will move up rates to keep the economy from overheating. We believe that the dollar will remain under pressure. And it's just interesting to note that in today's paper, in the journal, they talk about one of the keys to recoveries and a strong growth in the U.S. and other wealthier, quote, nations will be a weakening of their currency. And they actually print a chart from the International Monetary Fund, which I'm going to show also in a further slide. It happens to be that chart, that one. But they talk. The paper talks about the declining dollar as a necessity for growth in some of the emerging, in the markets like the U.S. and Europe. Let's see, first of all, where we think we are in the business cycle and why this portfolio makes sense today. In the early part of any expansion and stock market run, and this would be from March of last year when the market started to run through the end of the year, you typically get your best stock market returns. Now, in this particular graph, this is an average in past recoveries, and so during that period of time, according to this graph, the market's up about 22% on average, and of course, over the course of this last year, it's up a lot more than that, 60 to 80%, depending upon the time frame that you look at. As we move further into an economic expansion, the markets tend to not perform as well. You can't have 50, 60% returns every year. That just makes sense. We think we're in this late expansion stage. We think that we're somewhere in here. And if that's in fact where we are in the economic cycle, the expected returns on average have been, according to this report from ISI, 8.9%. Well, year to date, give or take, we're up 8.9%. So not only do we have the early expansion behind us, but we also may have most of the equity returns for 2010 behind us. Here's another chart of what we think we call a virtuous cycle and where we are in that cycle. And we started with a severe recession, an unprecedented worldwide stimulus, and as we moved that stimulus through the system, we're at the point now where inventories are being rebuilt, business confidence is clearly better. I saw an astounding number the other day where the Purchasing Managers Index for the state of California is 61.5. Now what that means is anything above 50 is expansionary. And 61.5, as near as I can tell, is about as high as it gets at the peak of economic cycles. Now, I'm quite surprised to see that for California. In any case, I think we're about here. We're about to the point where jobs are going to be added, and from there the economy becomes self-sustaining and takes off.
So, Jay, I'm sorry, I just want to interrupt for 1 second. I just got a note that some of the FCs are having difficulty logging in, and so if there are FCs that are on the line, if you can hear the audio part, it's my understanding that you need to click the manual download button. Apparently it's something with the firewall on the Schwab system is my guess. So if that helps anybody, click the manual download button. Sorry, Jay.
The the next slide is the International Monetary Fund's projections for global growth, and this is one I'm referring to that just coincidentally happens to appear in today's Wall Street Journal and talks about where growth is going to be, and in order for some of the more mature economies to grow, as an example the United States, that we're going to have to weaken our dollar versus the growth, strong growth economies, China, India, Brazil, and so forth. And this is pretty much consensus thinking, and we agree, but we think that in order to get growth going further, that you're going to have exposure to some of these high growth markets. So the goals of the 2010 portfolio are to achieve a larger percentage of the portfolio's returns from dividends. One of the first charts that I showed you talked about the bulk of the return for the U.S. market already being behind us. That was in 2009 and the early part of 2010. So going forward with a market that it may not go up as much, you may expect to get more of your return from dividends. The portfolio's goal is also to protect against inflation. If coincidentally in the paper today also, there's a chart showing the PPI for crude goods, the producer price index for crude goods. And that chart shows that from 2009 at the bottom to today, a lot of those commodities are up as much as 75%. Now that will work its way through the system eventually, and some of those costs are going to get passed on, and that's 75%. In February, that index climbed 28.6%. Those are astounding numbers. So if you project that into the future, you could well see some inflation from the costs of raw materials going up. We also want to have exposure to the faster growing markets, the ones that we showed on the chart previous. We want protection against a declining dollar. We talked about the fact that the dollar needs to decline to get any decent growth in countries like the United States. And of course, the goal is to find the right mix to achieve the above goals all in one portfolio. So how are we going to position ourselves? We're going to position ourselves with multinational companies that pay solid dividends and have a history of regularly increasing those dividends. Multinationals with exposure to the emerging markets as well as the U.S. market, and big sound dividend payers. We're going to expose ourselves to commodities designed to protect against inflation. Examples of that might be copper or gold or any of the other commodities that tend to, it can be iron ore, that go up and in line with inflation. We're going to expose ourselves to the faster growing, less indebted emerging markets. Well, we pointed out China and India and Brazil and South Korea, Latin America, and we'll pick those that we think are fairly priced and include them in the portfolio. You also want some exposure to currencies in commodity-rich countries that protect against the dollar declining. And the prime examples of that would be the Canadian dollar and the Australian dollar, both of which have appreciated significantly, but may continue to appreciate in the environment that we see going forward. The initial balance of the portfolio is 50% of large cap multinational U.S. dividend payers, and then 50% of the portfolio